So we have manufacturing accounts, and we can write and say that this is an account. This is an account prepared by entities, which engage in production processes. This is an account prepared by entities which engage in production processes. Let me write and say that the main objective or aim of the account, the main objective or aim of the account is to determine the production cost. The production cost. Or in other words, we can call it the manufacturing cost. The manufacturing cost. Then write another point and say that the goods produced are transferred to the sales department, at a profit. The goods produced are transferred to the sales department at a profit. So the profit can either be told that they were transferred at a markup, which is the profit on cost, or margin, which is the profit on the selling price, which is the profit on selling price. Then you write and say that the manufacturing profit is treated as other incomes. In the statement of profit or loss, statement of profit or loss, or the statement of profit or loss. That is the income statement, the profit or loss, the statement of profit or loss. Then, just to mention, this manufacturing profit, it has not yet been realized. It is not a realized profit. It's only that now, after production, the goods were transferred to the sales department or to warehouse, awaiting to be sold. So if they are transferred the profit, that profit is unrealized. That profit is unrealized, and we calculate what we call the provision for unrealized profit. We have what we call the provision for unrealized profit. So we can calculate it. We will see how we calculate it, and by that, it is always treated as an expense in the income statement. That's the statement of profit or loss. So the provision for unrealized profit, equals to the closing stock of finished goods, the the closing inventory or stock, closing inventory of finished goods, you divide by what we call the transferred value. In other words, is the sales value of the goods which were produced and transferred to the sales department or to the warehouse. Then you multiply with the manufacturing profit. You multiply with the manufacturing profit. To get a provision for unrealized profit is the closing inventory for finished goods. You divide by the transferred goods. I've said that the transferred goods is the amount of sales or the selling price at which the goods were transferred to the warehouse or to the sales department. Then you multiply with the manufacturing profit. Multiply with the manufacturing profit. Multiply with the manufacturing profit. So another point to write and say that the manufacturing account is prepared. The manufacturing account is prepared as shown below. The manufacturing account is prepared as shown below. So let's see how we prepare the manufacturing account. So we can have XYZ Limited manufacturing account. For the year ended, we can use 31st December 2021. We can use that as our end date. We are showing there. So we started we can create the raw materials which are used in the production. The raw materials. For the raw materials, we start with the opening inventory. Have the opening inventory. Then you add purchases of raw materials. At the purchase of materials. If there is any carriage inwards, you also add carriage inwards, you add. Then you less return outwards of materials. If you are given information about return outwards, reduce purchases, you less, and also you less the closing inventory of the raw materials. And what you get here is what we call the raw materials consumed. Utilized. These are the raw materials consumed or utilized. A raw material, that's a direct cost in production. Then we add other direct costs. In production, we add direct labor. We also add any direct expenses. That is, if any. And also we add what we call the royalties. And this will give us the total of all direct costs. And the total of the direct cost, we call it the prime cost. Those are the direct costs. Then we have the other section of what we call the overheads or indirect costs. Overheads, they are indirect costs. These are costs which are incurred in production, but they cannot be traced. They cannot be traced to the final product. They cannot be traced to the final product. So we have one, depreciation on plant and machinery. This one we record it here 100%. Naekanga hapa yote 100%. And if there's something to do with maintenance, if there's anything to do with maintenance costs, that is maintenance cost on plant, maintenance cost on plant. Then we have any other cost which has been allocated. These are the only two items which we bring here directly 100%. But now the examiner can give you other costs which now you allocate according to the proportions given. Then from there you just write any allocated cost. You can be given rent, you can be given electricity, you can be given power, all that. You can have any sort of expense or cost being allocated to this, either in percentages or even in fractions or even in ratios. So you allocate according to how you have been told in the question. Then from there we add what we call the opening work in progress. Opening work in progress. Then we less the closing work in progress. The opening work in progress, that's the opening inventory of work in progress. Closing work in progress, that is the closing inventory of the work in progress. So what we get here now, the total of the prime cost, plus all these indirect costs, and the overheads, will give us the production cost. The final one here, the total, this is the production stroke the manufacturing cost. This is the manufacturing cost. That's the manufacturing cost. And if they were issued at a profit, if they were transferred at a profit, we add the manufacturing. We add the manufacturing profit to the cost. And we get what we call now the transferred goods. So that is the manufacturing account format. That's a manufacturing account format. May 2019, question 4. So it says, Adam Musa operates a manufacturing business trading as AM Manufacturing Enterprise. The following trial balance relates to this business as at that 1st December 2018. So we have the trial balance there. We have factory building, plant and machinery. We have land that cost motor vehicles. And also we have been given the provision for depreciation for the 3 assets. The provision for depreciation also stands for what we call the accumulated depreciation. Then we are given the sales. Then we have purchase of raw materials. Then we have factory wages. The factory wages, we have office salaries. We have distribution costs, factory rates and insurance. We have provision for unrealized profit as at the beginning of the year, as at 1st January. Carriage on raw materials. That one we add to the purchases of raw materials. We have bank balance, trade receivables and trade payables. We have royalties paid. That's a direct cost. Allowance for doubtful debts. We have office rent and insurance. We have factory fuel. Factory fuel, that's an overhead. Then we have inventories. As at the beginning of the year, that is January 2018, opening inventories for raw materials, work in progress, and also the finished goods. So we have the factory's manager's salary, that's also an overhead. We have capital given there. Then we have the additional information. One, during the year, Adam Musa had taken raw materials valued 2.5 million from his store for private use. So those are drawings. Those are drawings, and they were of raw materials worth 25 million. Worth 25 million. That means we will less them. They will reduce the amount of materials. We will reduce them from the materials. So we will less them up. They were drawings on materials. We will less them. Then we have number 2. Manufactured goods are transferred to the warehouse at a cost plus. That is a markup, cost plus 25% of the factory cost. That's what we say. After getting the production cost, we transfer the goods manufactured or produced to the sales department or warehouse at a profit. We have seen that. So after getting now the total cost of production or manufacturing, we will determine the 25%, then we add it to the cost, we get the transferred goods. Then we have allowance for doubtful debts is maintained at 5% of the trade receivables at the end of the year. We'll also calculate that and see how much was it provided for. Then information 4, inventory as at that 1st December 2018 was as follows. So those are the closing inventories for raw materials, work in progress, and finished goods. Then number 5, accrued rates as at that 1st December 2018 were as follows. Those are accrued rates. Those are accrued rates for both factory and office. And we saw the adjustment, the accounting adjustment for the accruals. Accruals at the beginning of the year we minus, but accruals at the end of the year we add. They are part of the expenses payable. So we add them to the original expense cost. Then we treat them as current liability in the statement of financial position. Then we have number 6, prepaid insurance as at the end of the year. That is 31st December 2018 was as follows. That is the prepaid insurance for factory and also office. We have prepayments at the beginning of the year, we add. Prepayments at the end of the year, we less from the original cost of that expense. Then we treat them as current assets in the statement of financial position. So we are told that depreciation is to be provided as follows. They were given the asset and also the rate per annum. All of them, they are on cost. Factory building 2.5 on cost, motor vehicles 20% on cost, plant and machinery on cost. This means that they were using what we call the straight line method, where depreciation is charged on the cost of that asset. Then we are told the provision for unrealized profit as at the end of the year should be 800,000. So we will compare with the provision given at the beginning of the year. Then the difference, we will either determine if it increases, that means we will treat it as an expense, but if it is a decrease, that means we treat it as an income. Then we are told required manufacturing account, B, income statement, and C, the statement of financial position. Just one thing to mention, manufacturing companies or entities, apart from being required to prepare the manufacturing account, they are also required to prepare the income statement, which is the profit, the statement of profit or loss, and the statement of financial position. So we can start putting down that question and see what we have as the manufacturing account. So we have, they are calling themselves Adam Musa, AM, that is AM Manufacturing Enterprise. We have AM Manufacturing Enterprise, AM Enterprise, AM Enterprise Manufacturing Account, manufacturing account. For year, the year ended that 1st December 2018. Year ended that 1st December 2018. The 1st December 2018. So we start with the raw materials. We start with the raw materials. These figures were given them in thousands. So we start with the opening inventory of raw materials, opening inventory. Opening inventory of raw materials, whereby we are given them as the third item from bottom in the trial balance. We have 2,000. Then we add the purchase of raw materials. We add the purchases of materials. The purchases of raw materials we were given as 60,000. Purchase of raw materials. And also we had what we call the carriage cost. That's the carriage on raw materials. The carriage on materials. The carriage on materials, we are given a cost or an amount of 600. We add there. Then from there, we less the drawings. We less the drawings. We less the drawings. We less drawings. Drawings on materials. Drawings on materials. We withdrew, you took 2,500 for personal use. And also we less the closing inventory. The closing inventory of raw materials, which is given in information 4. In information 4, that 500 in information 4. So this will give us the raw materials consumed. Raw materials consumed. And the raw materials used or utilized. So how much will be that? How much is that? This is 62,000, 62,600. Then this is 6,000. So that will give us how much? 56,600. That's all. Confirm those figures.
56,600.
Then we add direct labor, and we were given the factory wages. Can you see the factory wages? The factory wages stand for the direct labor. Factory wages of 12,000. Then also we add the royalties paid. We have royalties which were paid amounting to 800. So this will give us the total of the direct cost, which is the prime cost. So 56,600 plus 12,000 plus 800. This one is giving us an amount of
69,400.
69,400. That is the prime cost. Then also we record the overheads and the indirect costs. The overheads stroke the indirect costs. Indirect costs. We can pick some from the trial balance, which are direct. So we'll pick, can you see factory rates and insurance? Can you see that? Factory rates and insurance. The factory rates and insurance, we are given an amount of 800, but we will adjust it. We are given 800. We are given 800. We're given 800. Then in additional information 5, we are told that we have accrued rates. 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 For the factory is 600. Accruals at the end of the year we add. So we add 600. We add 600. Then also number 6, we are told that we have prepaid insurance. For the factory is 300. Prepayments at the end of the year we less. So we less 300. We less 300. This is what will give us the store amount of the factory rate and insurance. So this is 1400 minus the 300, that is 1100. That is 1100. Then let's see the other cost that we have. We have factory fuel. Factory fuel, can you see that? These are costs which has been incurred, but it wasn't incurred directly or cannot be traced to the final product. Then also we have factories manager salary, the second last item. Factory manager salary of 650, of 650, of 650, of 650. Then from there now we calculate the depreciation. We calculate depreciation for plant. We calculate depreciation for plant. We calculate depreciation for plant and also for the plant where the building belongs to the factory. So we'll calculate loaded depreciation. That is for the building, the factory building. It's a factory building, so we'll take 2.5% of the cost of buildings. The cost of buildings, we have been told it is 4 million, so that is 4,000. Then also plant and machinery. Plant and machinery is 10% on cost. 10% of the cost of plant and machinery, 8,000. So this one we have it as 800. So how much is 2.5% of 4,000? Is it 1,000 or 100?
100.
100. So let's see whether we have any other factory cost which has been left. So we don't have any other cost which was allocated to factory. Don't have any other. So from there we add. So from there we add the opening. Add opening work in progress. The opening work in progress, it is the opening inventory of work in progress. We have given it as that 200. Is the amount that the third items there in the trial balance. Look at we have the inventories there. Then we less the closing work in progress. The closing work in progress in additional information 4 for 500. So the total of all this, the total from the prime cost plus all this minus 4500 will give us the factory cost. 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 So we have the factory cost and the manufacturing cost. The manufacturing cost. So itakuwa ya ngapi? From 69,400 plus 1100 plus 1200 plus 650 plus 100 plus 800 plus at 2 minus 4500 to give us a total cost of how much?
71,950.
71,950. 71,950. Then we add the manufacturing profit. The manufacturing profit in information, additional information 2, we are told that the manufactured goods are transferred to the warehouse at cost plus. Cost plus stands for markup. That is profit on cost. That is profit on cost. So we just take it directly. The rate times the cost. And we know how much was the profit. 25%. That is 25% of 71. 25% of 71,950 is how much? So 25% of 71,950. %.
17,987.5.
17,987.5. Then now we add it to the total cost and it will give us the selling price under the transferred goods. Selling price equals to cost plus profit, transferred goods. So this will give us a total cost of how, now a total of how much? This is the selling price under the amount of sales. Now, under the amount at which these goods are to be sold at.
89,937.5.
It is 89,937.5. 89,937.5. And that is the end of that manufacturing account. That's the end of that manufacturing account.